can I call Dave for joining the class?
He knows. I have posted it. He knows. If he is interested, he will join. Okay, let us start the class.
Okay.
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 So let me share my screen. Now, can you see the screen? Tell me. Hello, Sampriti.
No, sir. No, sir. Hello.
You see, there is a tab that SS Pali is presenting. Click on that tab.
Yes, it's the Professor Thursday. Okay. Okay.
Okay. Now, can you see the screen? Tell me.
No, no, sir. Only, sir, I'm seeing that Professor SomSubhra is presenting, sir.
Yes,
Only this.
yes. You click on that tab. You click on that tab.
Sir, I click it, but sir, only that part is showing, sir.
Because in my side it is showing that I am sharing the screen. You know how to just open the screen, isn't it? We did
Yes, sir.
so many
Yes, sir,
classes.
sir. Yes, sir.
I think there is some network issue from your end.
Exactly, sir.
Yes.
Sir.
Now is it okay?
Uh, no, sir. Only, sir, you are presenting the slide. Only, sir, that part is showing here, sir. Other no study material, nothing is, no screen is showing, sir. Here.
I don't know what's the problem because in my screen it is showing.
I think, sir, it's maybe network issue. Maybe it can happen.
Okay. Just a minute. I will again reshare the
Okay.
screen. Just a minute. Now can you see the screen
Yes,
right
sir.
now?
Yes, sir. Yes, sir. It's showing now. Yes, sir.
Okay. So first we have discussed the capital structure. Now we'll start with this equity share capital. Now before coming to this first equity share capital, let us try to understand the concept of this cost of capital. Cost of capital. Any idea regarding this cost of capital from Preeti? Because you did your BCom, you know that what this cost of capital means, isn't it? Shompriti, your takeaway on this cost of capital.
Yes, sir.
Yes, tell.
Sir, sir, basically, cost of capital is the uh, basic cost value of the equity share capital.
See, there are various type of capital. Equity share capital, debenture, both redeemable and irredeemable, preference share capital, redeemable and irredeemable, as well as loan. Okay, bank loan or other say loan from non-banking financial institution. So basically, to have this fund, you are thinking from the point of view of the company. Okay, from the point of view of the company. So to have this fund, you need to pay something to them because there is no free lunch. Unless and until you pay something to them, nobody, what can I say, nobody will supply fund to your company. So the amount, the fund that you are paying to the supplier of capital is called cost of capital. Now basically this cost of capital is determined by this formula. Please write it down. RO equal to risk free rate of return B equal to premium for business risk. F equal to premium for financial risk. Okay,
Okay, sir.
have you written the formula?
Yes, sir, I'm writing it.
Okay, so let us try to understand each concept very minutely. RO equal to risk free interest rate comprises of two factors, real interest rate and number two, purchasing power adjustment. Now, do you know this concept? Tell me, real interest rate and purchasing power adjustment. If yes, say yes. If no, say no.
Sir, currently, sir, no, no, sir.
Okay.
I think, sir, I read it at the time of becomes a but can't, sir,
Okay, okay. Not
I
me.
forget it, sir.
Not me. Say interest rate now. Say 6% per annum. This is your current interest rate. So this will be called real real interest rate because it depends on demand and supply of funds. Got it? This rate depends on the market, say market player, depending on the flow of credit, and accordingly this 6% rate is determined. This is called the real interest rate. Okay. Up to this, is it okay?
Yes, sir, it's okay, sir.
Now then comes purchasing power adjustment. You are aware of inflation, isn't it? Amol sir has taught you inflation during your,
Inflation is
yes, you while you were in, I think, first semester or second semester. So basically inflation. What it means? Tell me.
so basically inflation is when the price of the goods is increasing, then the demand of the goods is decreasing. The actually inflation is the price rising of the market.
Yes, basically there are two types. One is retail or consumer price index, another is wholesale price index. So every time the inflation is going up or going down. And who monitors this inflation? Tell me, who monitors this inflation from Pratik?
Um,
Because you need to face big, say, corporate. and they will ask not from your book but from practical knowledge. And in that case, if you falter, you become clueless, they will show you the truth. So it is not I am just what can I say criticizing you, but you try to imbibe this thing. You try to read business knowledge. You try to get business knowledge and try to read business paper. It's a very simple question. Who control inflation?
So basically, the cost controller of that particular
No, no.
company.
RBI, Reserve Bank
Also
of India.
from markets itself.
Reserve
Sir,
Bank.
if
Yes,
Reserve
tell.
Bank of India.
Reserve Bank of India.
Sir,
Through monetary policy. Got it?
yes, sir.
Now, can you just highlight how the Reserve Bank of inflation, Reserve Bank control this inflation? Because this is what I'm saying. They will ask you. It is for sure they will ask you in the interview.
Yes, sir.
Say if the money supply increases, isn't it? Money supply increases by how? Through bond purchase program of bank. What happens? Bank means RBI. What happens?
Sir,
Yes, just let me finish.
sir, basically, sir, RBI control this inflation, sir, by supplying of money in the market, sir. If when he supply more money in the market, then definitely the price of the good is rising.
Not correct. Let me finish. Say RBI purchase bond from the market. Who are the issuer of bond? Say other PSU bank. So whenever the or government. So whenever the RBI purchase bond from the market, what happens? There is a supply of money in the market. There is a supply of money in the market. The money supply is available in the hand of government as well as other PSU banks. So what happens? If money supply increases, interest rate falls. Got it? If money supply increases, interest rate falls. Got it?
Yes, sir.
Because if there is plenty of money supply, so nobody will give you higher interest rate to avail the fund. Okay. Similarly, if money supply decreases,
Interest rate
yes,
increases.
interest rate rises. Okay. And how money supply decreases? Any idea? How money supply decreases? Suppose I am an interviewer, I am asking you this simple question. You are a
Sir,
finance student.
basically, RBI produce the money, then but there is a particular they produce it a particular quantity when actually the money is more money is needed in the market, then they produced that particular amount of money. So
Not
No,
your
this process,
your
sir.
concept is not at all correct. Not at all correct. If money supply, how money supply decreases? Money supply decreases if the government or RBI say sell bond. If they are selling bond, what happens? People will subscribe to those bonds and they will squeeze the money from the system. Got it?
Yes.
So by bond purchase program, because you have seen there is a program called GSAP. Now the government has abandoned that project. Through that GSAP, the government control the interest rate. Got it?
Yes.
So you should be very careful. Now another thing you have told me that money, because say I am not teaching you from the point of view of exam, you will pass the exam for sure. I am teaching you for practical
Okay, sir.
reason for so that you can
Practical
you can face the big companies like KPMG and Price Waterhouse. Okay.
Yes,
Okay.
sir.
So money supply in India. So you tell me how we will determine the money supply in India. Can government say print as many notes as it can? Say suppose I am Mr. Prime Minister of India, I will say there will be no poverty in India, I will supply all the money to the poor people and they will have all the money in their bank account. Is it possible or is there is some rule? Tell me.
No, sir. This is not.
So why so? Can government print as much money as it wishes? If so, yes. If not, why?
So there should be maintain the money supply is equal to the reserve of the money.
Good, good, excellent. And what is that reserve called? What is that reserve called?
Sir, reserve of the money multiplier, sir, that I read. Sir, actually reserve of the
Just let me finish. Money supply equal to foreign exchange. Previously,
yes, sir.
it was only gold.
Foreign exchange
Gold.
reserve.
Now plus gold. Mainly, mainly through foreign exchange reserve. Got it?
Yes.
Now, this money supply is basically determined by GDP, gross domestic product. Depending on the gross domestic product, that is the demand for goods and services, this money supply is determined. We will supply that type of money that is equal to my GDP. Got it?
Yes.
So basically, actually I am diverting towards economics, it is not my area. But to help you to understand
Yes,
the
sir.
finance, because economics is a wide area. Unless and until you understand
Okay.
economics, you cannot understand finance. Okay?
Yes. Yes, sir. It's also a part of finance
Yes, yes.
because
Next comes repo rate and reverse repo rate. What is the difference and what it means?
sir, repo rate is a rate at which the Reserve Bank of India lends the money to commercial bank.
Good, excellent. And
Uh, and sir, reverse repo rate is the interest offered by the RBI to the bank who deposit the fund with them.
good, good, excellent, excellent. And what is the full form of repo?
Sir, repo rate.
Full form of
Sir,
repo.
full form of repo.
Yes.
Um, full form of repo rate. Sir,
Repurchase rate.
sir, repurchasing option. Uh,
Repurchase rate. Repurchase rate.
repurchase rate.
Yes.
Okay. Sorry.
So basically we have covered this real interest rate, and we have also covered the inflation. And what is the current inflation right now? Consumer price
Sir,
index, consumer CPI, how much is the CPI?
current CPI rate is sir 4.48%, sir.
Good, good. Approximately is okay. So basically government is taking an accommodating stance. So they are saying that 2% plus minus we can allow. Means it can come below 4%, that is 2%. It can be more than 4%, that will be 6%. So this 2% adjustment we can
Sir,
allow.
is it always more than 4%, sir?
No, plus minus 2%.
Plus,
Plus
minus
minus
2%.
2%. Okay. Anyway, we
Okay,
have
sir.
we have diverted from our concept. So far, I have discussed that is real interest rate and inflation. Next comes
Yes.
business risk. What do you mean by business risk?
Sir, business risk is the exposure a company or organization has to factor that will lower its profit or lead to it fail.
Suppose you want to start a business at Nigeria. Nigeria is a notorious place, okay, full of crooks.
Okay.
So there will be some business risk. Or there is a, if you say try to do businesses in Afghanistan, you know the situation. So business risk will be
Yes,
there.
sir.
So you need to add this business risk. Next comes financial risk. What is financial risk? You should
Sir,
know. I taught you this
fine.
financial leverage, operating leverage.
Yes, sir. Sir, financial risk is the possibility of losing money on an investment or business venture.
Mix of debt and equity. Mix of debt and equity.
Debt
Higher
and equity.
higher debt means higher interest
Yes.
rate, and higher equity means higher ownership risk. Got it?
Yes,
So
sir.
you need to make a balance so that your financial risk is covered. You cannot go to extreme extent that is full of debt, and you cannot go to extreme debt that is full of equity. Because Reliance Group, Mukesh Ambani is trying its best to make its company debt free. You have seen Adani Group, Ambani Group, they are just, what can I say? They are just redeeming their debt so that the company becomes debt free. The more the debt free, the more easier to do business, and the more will be the credit rating. Here the concept is called credit rating. What is that? You will learn in your fourth semester. Okay.
Okay, sir.
So basically I have covered this cost of capital. Now today I will cover cost of equity. Cost
Yes.
of equity. Equity means equity, share, capital plus free reserve. Okay.
Yes.
And equity share capital you know already I have discussed. So first method is you say KE equal to cost of equity capital equal to D1 by PE. K cost anticipated dividend at the year end P market price of equity share. Basically, this model says that we will determine the cost of equity, but we will assume no growth in dividend. This model says that dividend will remain constant, it will not grow. Okay. So depending on this, we will determine the cost of equity share, and that will be in percentage. Okay.
Yes.
Next model, same thing. You write number 2, only G. G means growth in dividend. Next model, K equal to E by M. E equal to earning per share, M equal to market price per share. Got it?
Yes.
So these are the various ways to estimate the cost of equity. Another is the CAPM. CAPM. K equal to RF plus beta I RM minus RF. This will you learn in your portfolio management in the fourth semester. RF means risk-free rate of return. Beta, this is beta. Beta of the investment. RM means RM means market rate. Okay, what is beta, that will explain in portfolio management. It does not come under the
Okay.
purview of this, say, corporate finance or credit review. So basically, these are the ways how you can estimate the cost of capital. These are the way how you can estimate the cost of capital.
Cost of capital.
Okay,
Yes.
so far we have discussed cost of capital and cost of equity. Cost of equity. Now, in my next class, I will discuss all the other costs and the weighted average cost. Because I have posted the note on Google Classroom, you just download the note. And the thing is that as no long question will come, I won't delve into big question. I will engage in your, say, concept building. Okay, I will try to
Okay, sir.
hone your concept.
Okay, sir. I will download it.
So, any question up to this point?
No, no, sir. Clear, sir.
Okay, so thanks for attending
Okay,
my
okay.
class. Have a nice day.
Thank you so much.